The UK government promised no new income tax rises. But what if I told you that by 2031, over 5 million more of us will be paying it anyway? Welcome. This deep dive was developed by the experts at ProTax Accountant. And in the next few minutes, we're going to unpack the hidden tax rises from the latest budget that are set to impact every single investor in the UK. We'll look at what's coming for your investments, your property, and your wealth. So how on earth is this happening? The government made a really clear promise, right? Yet somehow many of us are about to feel our tax bills climbing? Well, the answer lies in a series of pretty complex, targeted changes from the recent budget. These create significant and often totally hidden new tax liabilities for investors right across the UK. See, it's not about changing the headline rates you see on the news. It's about quietly changing the rules of the game underneath. To make sense of it all, we're going to break this down into 5 key areas. First, we'll look at the government's clever, silent strategy. Then we'll dive into the direct impact on your investments and property. After that, we'll cover the big changes for businesses, and we'll finish up with a clear strategic action plan. By the end, you'll have a complete roadmap of what's changing and what you need to do about it. Okay, first things first, let's understand the big picture here. With public finances under, let's say, a lot of strain, the government really needs to raise money. But they've painted themselves into a corner by pledging not to increase the big three: income tax, VAT, or national insurance. So they've had to get creative. What they've opted for is a far more subtle policy shift. It's clever, it's quiet, and it affects pretty much everyone with an income or an asset. And here is the one number you absolutely need to know: 5.2 million. You see, the government has frozen personal tax thresholds until April 2031. Now, as our wages and inflation inevitably rise over the next few years, this freeze means an extra 5.2 million people will be silently pulled into paying income tax. And get this, a staggering 4.8 million of those will be dragged into the higher rate band for the very first time. This whole thing has a name, It's called fiscal drag. And it's the government's #1 tool for raising more money from your earnings without technically breaking those big promises. Honestly, you can just think of it as a stealth tax. That pay rise might look fantastic on paper, but once you cross into a new tax bracket because of fiscal drag, you could actually feel worse off, as more of every single pound you earn goes straight to the tax man. And this right here gets to the absolute heart of the real story. The fiscal drag on your earnings, that's just the setup. The main event, the real strategy, is a massive pivot, a structural shift away from taxing what you earn towards a much, much greater focus on taxing what you own. And that means your investments, your savings, your property, and your business are all squarely in the crosshairs. Okay, so let's see how this pivot directly hits your investments. Now stay with me here, because these next few changes are going to affect anyone with shares, savings, or investments held outside of a pension or an ISA. First up, dividends. From April 2026, the tax rates on any dividend income you receive are going up by 2 percentage points for both basic and higher rate taxpayers. So if you're a company director who takes income as dividends, or maybe you're an investor with a share portfolio outside of an ISA, this is a direct hit to your returns. It's a straight-up reduction in your investment income year after year. And it doesn't just stop with dividends. Oh no! Starting the following year, from April 2027, the tax you pay on both your savings interest and your property income also rises by 2 percentage points. And this isn't just for one group. This increase applies across every single tax band: basic, higher, and additional rate. The message couldn't be clearer. The government is deliberately narrowing the gap between tax on work and tax on wealth. They're also tinkering with ISAs to kind of nudge our behavior. Pro tip for you: your total £20,000 annual allowance is staying put. But from April 2027, if you're under 65, you'll only be able to put a maximum of £12,000 of that into a cash ISA. The rest, that £8,000, has to go into a stocks and shares ISA. It's a really clear signal designed to push us towards more long-term equity investment. So what's the big takeaway from all this? It's actually pretty simple. Those tax wrappers, like your ISAs and your pensions, are now your most powerful defense. Using your full allowances every single year, that's no longer just, good practice. It's now absolutely critical to sheltering your assets from these guaranteed upcoming tax hikes. Now let's move on and look at the next step, this time for property investors. The private rental sector is facing a pretty significant squeeze, and these changes are going to be felt most acutely by smaller, independent landlords, the ones who are already feeling the pressure from rising mortgage rates and all the increasing regulation. This table here really lays out the new reality for landlords. From April 2027, rental income is effectively carved out and given its own separate, higher tax rates. As you can see, these new rates, 22%, 42%, and 47%, are a direct increase in the tax burden on your rental profits, which just makes it even harder to generate a healthy return on your property. And it's not just us saying it. Property experts at Savills have crunched the numbers, and their analysis is stark. This change is going to disproportionately squeeze smaller landlords who have mortgages. This is especially true since the relief they can claim on mortgage interest is already restricted to the basic rate. For some, let's be honest, profitability is going to become increasingly marginal. But that's not all, not by a long shot. Here's where things get really critical, especially for business owners and anyone who's thinking about their family's long-term legacy. And just a word of warning, some of these changes are effective immediately, so you need to be aware of them right now. So, did you know this? In a move that honestly shocked a lot of people, the tax relief for selling a business to your employees through an employee ownership trust has been slashed in half. And this change took effect overnight. This was an incredibly popular and tax-efficient way to plan succession, and this move just significantly alters the financial landscape for thousands of business owners planning their exit. Now let's talk about estate planning. The main tax-free allowance for inheritance tax, that $325,000 nil rate band, has been frozen since 2021. It was supposed to be reviewed in 2028, but nope, that freeze has now been extended all the way out to 2031. And as asset values, like your home, continue to rise, this freeze means more and more estates are going to get caught by that hefty 40% inheritance tax. And another one, a really popular tax-saving tool for employees is also being capped. From April 2029, only the first £2,000 of pension contributions you make through a salary sacrifice scheme will be exempt from national insurance. Any amount you sacrifice above that will be subject to NI, which reduces the benefit for both you and your employer. So with all these pretty significant changes on the horizon, what can you actually do? Look, this is not a time to panic, but it is absolutely a time for proactive, strategic planning. So let's walk through the key steps you need to take now to get your finances ready for this new environment. Here are 3 crucial steps every single UK investor should be thinking about right now. First, prioritize those tax wrappers. Make filling your ISA and your pension your #1 financial goal each and every year. Second, if you own a business, you need an urgent review of your succession and exit plans, given the changes we just talked about. And third, everyone should take a hard look at their portfolio. Does the current structure still make sense in this new, higher tax world? Now, it's really important to remember that everything we've talked about here is for general informational purposes only. You shouldn't rely on it exclusively to make big financial decisions. Your personal circumstances are completely unique, and the right strategy for you is going to depend entirely on your specific situation. So, the crucial question I want to leave you with is this. Is your financial plan truly ready for this new tax reality? Because the ground is fundamentally shifting under our feet. Before you make any decisions at all, you absolutely must consult a professional for advice that is tailored specifically to you. The tax experts at ProTax Accountant, who developed this entire analysis, are ready and waiting to help you navigate these complex changes. They can help you review your position and really optimize your financial strategy for the years ahead. You can reach out to them directly using the WhatsApp, phone number, or email details you see on the screen to schedule a consultation. They can help with everything we've discussed today and any other tax issues you might have. Thank you so much for watching.